Hey everyone, so have you ever just stared at a stock chart and wondered, is this company actually any good? Well, today we're going to cut right through all that noise. We're talking about one of the most powerful tools an investor has, fundamental analysis. And don't worry, we're going to break it down in a way that's super simple and practical. Let's dive in.
This is the big one, isn't it? It's the question that's on every new investor's mind. You see a stock price jumping all over the place, you hear the buzz online, but how do you really know if the business itself is a solid long-term bet? That's exactly what we're going to solve today.
And this right here is the absolute most important mindset shift you can possibly make. If you get this one idea, everything else will fall into place. You're not just buying a little ticker symbol on a screen, you are becoming a part owner of a real, living, breathing company. So, what is this fundamental analysis thing anyway? Well, think of yourself as a detective. You're ignoring the day-to-day gossip and drama of the stock market, and you're focusing on the real clues, the health and strength of the actual business. You're asking the important questions, like, is this company actually making money? Is it growing? Is it built to last? This slide really just nails the difference, doesn't it? On the left, you've got the stuff that actually matters, the business itself. Its sales, its profits, its future potential. And on the right, that's all the market noise, the daily mood swings. Fundamental analysis teaches you to just live in that left column and ignore the chaos on the right. So here's our game plan. We're going to build your toolkit around three core areas. First, we'll get into the business story, what the company is all about. Then we'll do a quick financial health check. We're talking numbers. And finally, we'll figure out if we're actually paying a fair price for it. Okay, let's kick things off with part one, the business story. Seriously, before you even think about looking at a financial report, you have got to understand what it is you're actually buying. This is step one, and it's non-negotiable. Start with the absolute basics. Can you explain to a friend, in simple terms, what this company does and how it gets paid? If you can't, you need to do more homework. And then think ahead. Are people still going to need this product in 5, 10, or even 20 years? And this gets to the next layer. What makes this company special? What's its secret sauce? Does it have a brand that everybody knows and loves? Or maybe some crazy technology that nobody else can copy? This competitive advantage is like a protective moat around a castle. It keeps the bad guys, the competitors, out and lets the company thrive for years to come. This is something a lot of people just flat out overlook, but it's so critical. You can have the best product in the entire world, but if the person steering the ship is making terrible decisions, well, the whole thing can sink. You want to see a management team that has a clear vision and a history of making smart moves. And honestly, it doesn't get any simpler or more powerful than that. That quote right there sums up this entire section. If you don't get it, if it feels too complicated, just move on. There are thousands of other companies out there. All right, let's move on to our second section, the financial health check. Now we're going to get into the numbers, but listen, don't get nervous. We're going to keep this really, really straightforward, I promise. We're going to start with the two big ones. Revenue, that's the top line. It's all the money that comes in the door from sales. Easy enough, right? Then there's profit, or what people call earnings. That's the bottom line. It's the cash that's left over after the company pays for absolutely everything. Salaries, rent, materials, you name it. So what are we looking for with these numbers? It's one word, growth. Just like this chart here shows, you want to see a company that's consistently bringing in more money and making more profit year after year. A nice, steady upward trend is one of the best signs of a healthy, growing business. Okay, next step, debt. Now, not all debt is bad. Good companies often borrow money to grow faster, but too much debt, especially if the company isn't making much profit, that is a huge red flag. A much healthier company has its debt under control and, more importantly, has strong cash flow, lots of actual cash coming in to cover its bills easily. If you only remember one thing from this whole numbers section, please make it this. Over the long haul, a company's stock price is almost magnetically pulled in the direction of its earnings. If a company keeps making more and more profit, there's a really, really good chance its stock price will follow right along. Okay, so we found a great business with amazing numbers. We're done, right? We should just buy it? Well, not so fast. This brings us to our third and final piece of the puzzle, paying the right price. This is a lesson every single investor learns, and trust me, sometimes they learn it the hard way. Finding a fantastic company is only half the job. If you pay way too much for its stock, you could still end up losing money, even if the business itself does great. So how do we know if we're overpaying? Well, one of the most common tools is called the PE ratio. The simplest way to think about it is like a price tag. It just tells you how many dollars you have to pay in stock price to get one single dollar of that company's profit. Now here's the tricky part. A high PE isn't automatically bad, and a low PE isn't automatically a bargain. A high PE might mean investors are super excited and expect massive growth. A low PE could mean it's a hidden gem, or it could mean there's a serious problem nobody's talking about. The key is context. You have to compare it to that company's own history and to its direct competitors. All right, let's bring all these pieces together. Let's talk about how to put this all into practice and, maybe more importantly, how to avoid some really common mistakes. The biggest trap you can fall into is getting obsessed with just one thing. Maybe it's a low PE ratio or amazing revenue growth, and then you ignore everything else. It doesn't work that way. A great investment is like a puzzle. It has a solid business story, growing numbers, and a fair price. It's the whole picture that matters. So, to make this all super practical and easy to remember, here's a simple checklist you can use every single time you look at a new company. And here it is, your 9-point game plan. It pulls together everything we've talked about. You start with the story. Do you get the business? Then you check the numbers. Is it healthy? And finally, you evaluate the price. Is it worth it right now? This is your guide to seeing the whole field. And remember, always, always think long term. And that's really what it all boils down to, isn't it? Fundamental analysis isn't about finding some magic formula or being perfect. It's just about making smart, thoughtful decisions based on the reality of the business. The more you understand what you own, the better an investor you're going to be. So, my question to you is, what company will you start analyzing first?